Welcome back. I'm Michael Bull, and this is America's Commercial Real Estate Show. This segment is brought to you by GetValuate.com, online investment analysis that you should check out. Today we're talking about single-tenant net lease investment properties. My guests are Fred Weir. He's president of Meadowbrook Restaurant Co, and Nancy Miller, president of the National Net Lease Investment Group with Bull Realty. And before the break, we were talking a little bit about some ways to understand if you're getting good value. And I think a lot of investors, when they're looking at single-tenant net lease properties, they're wondering, well, what tenants are safe? What's a great tenant? So what are you seeing out there as the hot tenant that investors like investing in these days?
Well, there are several sectors we noticed just recently, and I have a couple notes just because I hoped you would ask me that question. But the dominant sector that most transactions are occurring in are what we call QSR, quick service restaurant sector. 17% of the transactions that we followed last year were QSRs, and it would be a Wendy's, it would be a Burger King, a Bojangles. Zaxby's is kind of a hybrid, by the way, between those because it's of its nature. Dollar stores were the top volume-wise in terms of how many new units were built between the Dollar Generals, Family Dollars, Dollar Trees. They were only 10% of the gross volume. Casual dining, which would be your Applebee's, your Chili's, and so forth, your Outbacks, well, a little bit higher, and sort of your Zaxby's were about 6.5%. Drugstores, Rite Aid, CVS, Walgreens were about 6% of volume. Auto-related going down 4%. One of the interesting things I wrote is one particular tenant, Starbucks. They were 3% of the total, but what I was shocked with is Starbucks in 2017 opened 45 new units. In 2016, they opened 26 new units. They've almost doubled the unit numbers that they've opened in the sample that we did. I'm sure they've opened more than that, but Starbucks is the big one in terms of for their units, their unit growth.
Yeah, I think we've all doubled our intake of coffee. See how fast we're talking these days? We're all drinking more coffee, I think. So let's talk about some ways to maybe increase returns for investors. For example, most single-tenant net lease properties are triple net, and the tenants take care of the operating expenses and the taxes, insurance, but some of these leases are double net now, right? Can an investor maybe get a little more return for that additional work or risk?
Absolutely. An investor who wants to improve their leverage or return, or their yield or return, a double net, if they want to take on a little more responsibility, roof and structure maybe, parking lot, they may get 0.5% or 50 basis points higher of a cap rate or even more. And if they also want to take a shorter lease term because they say, this is great real estate, I don't mind being here even with a shorter lease and a double net because, wow, it's Main and Main and I can do something with this if for chance that tenant does not renew sometime in the future.
Now, and I see very experienced real estate people that will look at that sometimes, but what about the more casual investor who maybe doesn't do commercial real estate investing for a living, and he's looking at a tenant that has 7 years or 4 years? What are some ways that investor can kind of come in and look at, hey, is this tenant doing well? I guess with some tenants you can get sales numbers, right? But not a lot of these single tenant?
You mostly can get sales numbers on franchises more often than corporate tenants. The national credit tenants don't like to discuss or divulge. But if you get the sales information, that's great. And that's one of the measures to say, is this a safe buy? As we were talking about earlier, go in the parking lot. Sit there for some time and watch what's going on and seeing the traffic. Is it easy to get access in and out of that location? How is the signage? Is it sitting low to the ground or is it a nice big sign? Can you see it from somewhere? Are the traffic counts high enough? Again, it amounts to if the even if that tenant is mismanaged or not operated well, if the other factors or the other particulars are good, you know, an investor who has a little bit of stomach for it is going to do fine with that property.
And Fred, if you were invested in a single tenant net lease deal with your experience as an operator, what would be some other ways that an investor might kind of get an idea if that operator's doing well and might renew?
Much to what Nancy said, you know, you can look at a lot. There's so much data out there for you now. I mean, you can buy so much data and metrics that, again, you have all these numbers on a laptop that may give you one picture. And we still, even when we're determining that, and when we've looked at even buying other people out, we're very old school. If we're going into a new area, we go and hang out. Just because there's a lot sometimes in reality, much to that same thing. We'll go, and if it's a restaurant, we'll sit in other restaurants. And you'll be amazed just, you know, talking to a server or the cashier that's waiting on you, and just sitting in the dining room, what you can find out. And they'll always be very candid. They'll be very honest with you. And you know, about, you know, say, well, how are your lunches usually like this? And yeah, it's just, you know, ever since they've been planning road construction, or they're planning road construction or whatever, you'd be amazed what people will tell you, even from just the caliber of help that's available in that area. And two, again, just the traffic, and then just doing some things. You know, things can look one way when you're looking at a plat or a map or even Google Earth, but it's another thing when in the middle of lunch you're trying to make a left-hand turn and there's only a stop sign. And you know, we personally have passed on a couple sites just because my wife was in the car and she made the comment. She's like, "There's no way I'd ever go to that restaurant." She says, "I wouldn't want to make that left turn." And things that are just that simple, and maybe not a big deal to me, but to other people that are going to be our core guests, that, again, you're never going to see on a chart, you're never going to see on some kind of graphic, that just in real life.
Yeah, well, I'm glad to hear you say that research and going and hanging out in these places is good, because when my wife gets mad at me for drinking in a bar, I'm going to say it's research, darn it.
Yeah, exactly. That's right.
I had to check out the market area.
I had to stay for the second drink. The first drink was research. The second drink was I was learning so much.
So what is changing now, you know, with the internet and so much competition? So many restaurants seem to be opening everywhere. It seems like retail has changed to more of an experience. There's more restaurant. What do you see as the operator side that you're having to do differently in kind of growing into these days?
Well, you know, I think having a relationship with our guests is key, and the chains that really get that, and get that sincerely, because there are a lot of them out there that may throw a bunch of stuff, but there's no sincerity to it. But the brands and the operators who truly understand that from a sincere standpoint, we're constantly trying to stay tangibly connected with our guests, because there's so many new brands and there's so much distraction.
And how are you staying connected with them?
Certainly social media, and doing things where we can, as well as different promotions and things we can do where we have the opportunity to interact with our guests, either electronically or, you know, touching them through the store. And we've even done some innovative things with some of our younger guests, where we've created 3-month ambassador programs where we say, hey, if you retweet these things for us, or if you share things on Facebook or Instagram, we have little cards for them where they're a Zaxby's ambassador, and it gives them one free meal a week, and again, but we were able to get messages out, as well as build kind of a cadre of having relationships with guests, because certainly when they're doing that, we're keeping them connected, and they have a vested interest, because they, kind of get hooked up with free food and some other discounts.
That's great. How about the Uber impact? What are you seeing there?
I think that is certainly something that is, I think we're kind of on the cusp, and I think that's only going to grow. There are a lot of players that are moving into it. Certainly it's not pervasive yet, where they're in every market and everything. They're in major cities. With Uber specifically, and it's starting to change with some competitors, and I think with their own realities, they signed, Uber right now wants about 30% of your sales, and they strongly discourage or do not allow you to raise your menu prices to account for that. And so with any franchise brand, your food and labor cost is going to probably be somewhere in the neighborhood of 50 to 60%. Well, if you're suddenly, chopping off by the time you pay royalties and advertising and then paying 30%, it's a zero-sum game. But as more players get in and the people providing that service become more efficient at doing that, you're going to see that number go down, and I think that becomes a more significant opportunity, because certainly a lot of guests and guest trends are moving that way. People aren't necessarily dining in as much.
No.
We're already seeing a huge uptick in just drive-through stores that offer delivery and things like that. And so I think it's a natural progression of the market, and everyone has to be aware of it.
Yeah, I mean, if I can eat without getting off my couch, I'm good to go. I'm watching the football game. I don't want to get up. I just want to get on my phone, have it delivered, right?
Well, and the ease of that, there's certainly a lot to be said for that. I mean, you see that across the board in retail trends. I mean, mall traffic is significantly down. Amazon's the 800-pound gorilla that even bigger retail tenants have to compete against and measure their numbers against. And to that accord, I think all of our guests, the same guests that are shopping on Amazon and seeing the convenience of that, aren't necessarily going out to eat as much anymore. They're wanting to stay at home and draw up a movie on Netflix or Prime or something like that. They may not even have cable in a lot of cases, and they're solely watching their whatever entertainment they are off of digital. And when they do that, they're wanting things brought to them. There's certainly a trend in the way our younger guests are eating, and we're having to be aware of that as well.
What percentage of your costs are for payroll, typically?
They're going up. By the time we include management now, you're depending on the market, anywhere from 25 to 30%, all in with everything that we actually have to pay out.
And what do you think about the kiosk ordering? People coming in and ordered either online at home and coming in and picking it up, or online in the store with a kiosk?
It's funny you mention that. It actually, and I had an IT guy with another brand kind of rhetorically ask me that, and I think that it almost is in some ways an anachronistic technology. And the way that he described it to me was, he says, you obviously know everything about Netflix and Amazon. He said, if Netflix and Amazon wasn't out, but you knew it was coming, but you have the understanding and knowledge that you do today with it being out. And if I told you, hey, I'll sell you a VCR, but you got to have one for each TV. The VCRs are $5,000 a piece. And you have to have at least 5 to order efficiently. So you're talking about a $25,000 investment. There's some wiring costs. All in, you're going to have $30,000 for VCRs. Knowing what you know about Amazon and Netflix, would you do it? I'm like, heck no. And he then pulled out his cell phone, and he said that the technology is for our industry is right on the cusp, where people will be able to order on their phone, and rather than say, yeah, I want it at 12:15, but then all of a sudden they get stuck on a conference call, and one of the realities is they don't show up until 12:45. Well, what happens? The operator either has to remake their food or their food's cold. But the technology with this will let the store know just through geotagging the minute they show up onto the parking lot.
Nice.
That guest is there.
Yeah.
It will then automatically let you know whether they open the door to come in to your restaurant, that, hey, that guest is at register 1, or they're the third car in line in your drive-through. Everything's going to probably automatically be done, just taken out, almost like an Apple Pay type thing. We'll know exactly just based on that geotagging and from their phone. And the way he described that to me is, he said that the technology in the industry, he said, is really almost there, and that within 2 years, he says the kiosks are already obsolete and a dinosaur, and you're going to see everything be across the board, and that's the way that ordering, and certainly it will take off a lot of the pressure for labor that our entire industry is seeing, because obviously you can operate more efficiently. And it's not necessarily that people are going to lose jobs or jobs are going to be replaced, because everyone is struggling for that same pool of people right now. And so it will allow the industry as a whole to more efficiently use the people that are available to begin with.
What do you think, and what do people in your field think about minimum wage increases? It seems like, having been able to start in some of these fast food places as a kid, to get a kind of learning how to have a job and how to deal with a boss and being responsible. But if we keep raising those rates that you have to pay those people, and then we go to phones and technology and these jobs, how do you guys feel about that, raising rates?
Well, we could, maybe we need to do a 6-hour show nonstop just on that whole subject. In all seriousness, there are two issues with that in our industry overall. Certainly, any operator that's out there that's doing it right, if you said, well, how many people do you have at minimum wage, they'd chuckle right away, because the reality is, even with our younger people and our teenagers, you cannot pay minimum wage today. It's a fallacy that the government's doing for alternative motives that have nothing to do with the retail sector or minimum wage in and of itself. That being said, just the available pool of labor, there are several things that have, I think, got us to where we are. And especially you mentioned like the teenager that gets the job. A lot of them aren't working anymore. And the reality is, it's not so much that teenagers have become lazy or they don't want to work, but their parents don't want them working. Mainly because they want them to look perfect on paper for college.
Yeah.
But the reality is that these same kids are getting away to college, and then the reality of multitasking and everything in life. And I sit on the board of trustees for a university and can certainly speak on the opposite side of this, because you're seeing the reality of that college dropout rates have gone up significantly across the board, regardless of whether it's an Ivy League school or a public 2-year tech school. The rates are very consistent, and what they're finding, that the rates of kids that are having to be medicated for anxiety has increased, and I think that there's a correlation, because kids are not getting out and working, and it's not that they need that job for money and everything like that, but sometimes that job serves as a midwife to start really preparing them for their collegiate career and their business career, and that's not happening just due to just an evolution and a perception of what people need to do to be successful.
Yeah, I think that it's good for them. I mean, when I was in high school, I was a night manager of a steakhouse, and I handled employees, and I handled the numbers and the deposit, and I think it was good leadership for me to have done that, and I think it's something we need. Well, we're going to take a short break. When we get back, we're going to wrap this up with some great information from my guest. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.